The Pentagon just became the largest shareholder in MP Materials, a rare earth mining company. The Department of Defense has never taken an equity stake in a private company before. Never. Not during the Cold War. Not after 9/11. Not during any previous national security crisis. The question isn't why they did it. That's obvious. The question is why they did it now. And when you understand the answer, you'll see why the next 5 years will determine who controls the technology that runs the world. My name is Alex, and for the past decade, I've been tracking commodity cycles and critical mineral supply chains so you don't have to. I read International Energy Agency reports and rare earth export data at 3 in the morning because this stuff matters, and nobody else is connecting the dots for everyday investors. If you want to understand where the real money is moving before the market catches up, make sure to hit that subscribe button and give this video a thumbs up if it helps you see what's coming. Before we dive in, I want to know, what's your silver price prediction by end of year? Drop it in the comments. I'm curious where this audience stands on precious metals because what I'm about to show you is happening in metals most people have never heard of. Here's the thesis. Every electric vehicle, every artificial intelligence data center, every smartphone, every advanced weapons system, all of it depends on a handful of metals that nobody talks about. Lithium, cobalt, rare earth elements, graphite, and there's a single point of failure in the global supply chain for all of them. China, not just mining them, processing them, refining them, turning raw ore into the materials that actually matter. And right now, the United States and Europe are realizing they've handed China a kill switch to the entire 21st century economy. The scramble to fix that is creating the biggest resource investment opportunity since oil in the 1970s. But you need to understand what's actually happening, because this isn't about buying a mining stock and hoping. This is about understanding a structural shift that will reshape global power for the next 30 years. Let me show you how deep this goes. China controls over 90% of rare earth processing capacity, not mining. Processing. That's the leverage point. You can mine rare earths anywhere. There are deposits in California, in Texas, and Australia, but turning those raw materials into usable products? That requires knowledge, infrastructure, and environmental tolerance that only China has built at scale. They control 94% of permanent magnet production. Those are the magnets in every electric vehicle motor, every wind turbine, every precision-guided missile. Without those magnets, the entire green energy transition stops. The entire defense industrial base stops. Cobalt. China owns or controls 80% of cobalt mines in the Democratic Republic of Congo, which produces 75% of the world's supply. Then, China refines 68% of global cobalt. So even if you mine it somewhere else, you're probably sending it to China to be processed. Lithium? Roughly 70% of global lithium refining happens in China. They don't have the most lithium reserves. Australia does. South America does. But the facilities that turn lithium ore into battery-grade lithium carbonate or lithium hydroxide, almost all in China. Graphite, 79% of natural graphite mining. Over 90% of processing. Every lithium-ion battery uses graphite. There is no alternative chemistry at scale. China controls the pipeline. And then there are cathode materials and anode materials, the actual components inside batteries. China controls 96% of cathode production. 85% of anode production. At every single stage of the battery supply chain, China has built a chokehold. This isn't an accident, this was strategy. While the West was outsourcing manufacturing and chasing quarterly earnings, China was buying mines, building refineries, and subsidizing an entire industrial ecosystem. They played the long game, and now they're playing the end game. April 2025. China imposed export controls on 7 rare earth elements, not a ban. Controls. You need a license. You need approval. And approval can be delayed, denied, or made conditional on things Beijing wants. This was retaliation for Trump tariffs, but it was also a demonstration. A reminder, you need us more than we need you. What happened next? United States manufacturers had to cut production. Some shut down factories entirely. European rare earth prices surged to 6 times Chinese domestic prices. 6 times. Imagine if gasoline was $6 a gallon in Europe and $1 in China, and China controlled the refinery. That's the situation. October 2025. China expanded the controls. 12 rare earth elements now restricted, plus permanent magnets, plus lithium battery technology, plus graphite. And here's the part that changed everything: extraterritorial reach. If you make a product outside China using Chinese materials or Chinese technology, you need a license from Beijing. That's not a trade policy. That's leverage over the entire global supply chain. That's the ability to decide who gets to build electric vehicles, who gets to manufacture batteries, who gets to produce defense systems. Then, November 2025. Trump and Xi met. China agreed to suspend the second wave of controls for 1 year, until November 2026. The media called it a trade deal, a de-escalation. But here's what they didn't tell you. The April controls, still active. The 7 rare earth elements restricted in April, still restricted. The suspension was tactical. Beijing gave up nothing that matters. They kept the leverage and bought themselves a year to watch the West scramble. And here's why that matters for you as an investor. The European Central Bank released a study showing that over 80% of large European firms are within 3 intermediaries of a Chinese rare earth producer. 3 steps. That's how close the entire European industrial base is to a supply cut. Lithium makes up 20 to 25% of total electric vehicle battery cost. Raw materials could account for 20 to 40% of battery costs by 2030. Some battery chemistries, over 50%. When China controls the materials, they control the margins. They control who wins and who loses in the biggest industrial transition since the internal combustion engine. Now let's talk about cobalt, because this is where the crisis gets real. The Democratic Republic of Congo produces 75% of the world's cobalt. In February 2025, the DRC government did something nobody expected. They banned cobalt exports entirely, completely, zero. The reason? Cobalt prices had been in free fall for 9 years. Oversupply. Mines were losing money. The DRC was watching the one resource they actually control get sold for nothing, while China bought it up and stockpiled it. So they stopped the bleeding. Total export ban. Then in October 2025, they replaced the ban with something more strategic. Quotas, 96,600 tons per year for 2026 and 2024. That's roughly half of what they exported in 2024. An OPEC-style supply squeeze, and they didn't stop there. 10% royalty, 5% strategic minerals levy. Every ton of cobalt exported now carries a 15% tax, and they reserve 900 tons per year as a DRC strategic stockpile. They're not just controlling supply, they're building their own reserves. What happened to prices? Cobalt surged 16% in 2025. From 169,000 RMB per ton to 452,800. European cobalt metal prices up 139% year over year. And here's the kicker. By January 2026, China's cobalt inventories were depleted, gone, no buffer. For the first time in years, China didn't have a cobalt stockpile to smooth out supply shocks. They're now exposed to the same shortage as everyone else. Benchmark Mineral Intelligence is forecasting cobalt will average $25 per pound, or $55,150 per ton in 2026. S&P Global says the cobalt market will likely stay in deficit through 2026 and 2027. The global supply deficit could be anywhere from 6,000 to 25,000 tons this year. But here's where it gets interesting. Battery makers are trying to diversify away from cobalt. LFP batteries, lithium iron phosphate, are cobalt-free. They now hold over 90% of grid storage market share. LFP is projected to exceed 60% of global battery cell capacity in 2025. So is cobalt demand just going to collapse? Not quite. Because while LFP works great for grid storage and cheap electric vehicles, it doesn't work for premium EVs. Tesla uses LFP in some models, but Mercedes, BMW, American automakers, they still use NCM batteries. Nickel, cobalt, manganese. Those batteries have higher energy density, longer range, better performance in cold weather. And every single one of them needs cobalt. North America and Europe are still locked into cobalt-dependent chemistry. The shift to LFP is happening, but it's not happening fast enough to save the premium EV market from this supply crunch. So you've got China controlling rare earths and processing. The DRC squeezing cobalt supply. What about lithium? Lithium crashed hard. From 2022 peaks, lithium carbonate prices fell over 80%. Oversupply. Too many new mines. Too much speculation. Prices bottomed out around $10,800 per ton in mid-2025. Every lithium miner on Earth was losing money, projects were getting shelved, expansion plans canceled, and that's exactly when smart money started paying attention, because the demand story didn't change. EVs are still coming. Energy storage is still growing. The crash was a supply glut meeting a temporary demand slowdown. That's not permanent, that's a setup. Second half of 2025, lithium carbonate rose 56%, from $10,798 per ton to $16,882. Fast Markets forecast a small surplus in 2025, shifting to a deficit of 1,500 tons lithium carbonate equivalent by 2026. Benchmark Intelligence says $15,000 to $17,000 per ton average for 2026. Some analysts think it could hit $28,000 by late 2026. Why? Because supply cuts. Miners that were bleeding cash shut down production. New projects that were supposed to come online got delayed or canceled. Meanwhile, demand keeps growing. The global EV fleet is 58 million vehicles today. It's projected to hit 235 million by 2030. That's nearly 4 times. Lithium demand is 1.8 million tons lithium carbonate equivalent in 2025. It's expected to hit 3.7 million tons by 2030. Doubling. Batteries currently absorb about 61% of lithium demand. By 2030, that's projected to be 81%. Grid-scale battery storage exceeded 90 gigawatt-hours in 2024 and is growing at over 30% compounded annual growth rate. The lithium-ion battery supply chain is projected to be worth over $400 billion by 2030. And here's the supply problem. Even if every announced lithium project gets built on time, supply will only cover about 85% of demand by 2029. There's a structural gap. New lithium mines take 10 to 17 years to develop. Recycling won't meaningfully impact supply until after 2030. The setup is there. Prices crashed. Supply got cut. Demand keeps growing. Deficit emerging. That's the classic commodity squeeze. And China still controls 70% of refining, so even when new supply comes online, it's probably getting shipped to China to be processed. Now here's where the US government enters the story. And this is the part that tells you how serious this has become. March 2025. Trump signs an executive order titled Immediate Measures to Increase American Mineral Production, expands Defense Production Act authorities. That's the same law used to mobilize industry during the Korean War. They're dusting off Cold War-era powers. February 2026. The State Department announces Project Vault. $10 billion in EXIM direct loans for a domestic strategic mineral reserve. Largest loan in EXIM history. $10 billion. That's not a subsidy. That's the US government buying physical materials to stockpile. They're building a reserve the way China did 20 years ago. Except they're doing it in panic mode, paying top dollar because they're late. The Pentagon has committed $4.5 billion in just 5 months for 6 critical minerals deals. 5 months. The Department of Defense doesn't move fast, ever. But they're moving now. They bought $400 million in preferred stock in MP Materials, the only active rare earths mine in the United States. The Pentagon is now MP Materials' largest shareholder. Think about that. The military owns a mining company. They put $1.4 billion into a joint partnership with ReElement Technologies for domestic rare earth magnet supply. Another $1.6 billion into Rare Earths USA. These aren't loans. These are equity stakes. Ownership. The US government is becoming a player in the mining business because the private sector can't build fast enough and China has too much control. EXIM has issued $14.8 billion in letters of interest for critical minerals projects under the Trump administration. The State Department held the 2026 Critical Minerals Ministerial. 54 countries attended. 43 foreign ministers. This is resource diplomacy at a scale not seen since the 1970s oil crisis. There's a bipartisan bill in Congress proposing a $2.5 billion agency dedicated to critical minerals stockpiling and production. Bipartisan. When was the last time Congress agreed on anything? The private sector is responding. Rio Tinto just spent $6.7 billion to acquire Arcadium Lithium. They're targeting over 200,000 tons lithium carbonate equivalent per year by 2028. CQM is expanding Salar de Atacama in Chile to 240,000 metric tons lithium carbonate by 2026. Lynas Rare Earths is building a processing facility in Texas. First rare earth refinery outside China in decades. MP Materials is scaling up Mountain Pass in California. Novion Magnetics is the only US manufacturer of rare earth permanent magnets, and they just signed a memorandum of understanding with Lynas to secure supply. Evolution Energy is building the first U.S. solar-powered cobalt refinery in Yuma, Arizona. These are billion-dollar bets that the U.S. can rebuild a supply chain that got gutted over 30 years. So how do you play this as an investor? Let's break it down by metal. Lithium. The big names are Albemarle, ticker ALB, SQM. Lithium Americas, ticker LAC. Rio Tinto, ticker RIO. QuantumScape, ticker QS, if you want exposure to solid-state battery tech that could change lithium demand dynamics. ETFs, Global X Lithium and Battery Tech, ticker LIT. Amplify Lithium and Battery Tech, ticker BATT. Albemarle's 2026 earnings per share consensus is up 207% year-over-year according to Zacks. That's not a typo, 217%. The market is pricing in a massive lithium price recovery. Cobalt and diversified battery metals. Glencore, ticker GLNCY. BHP Group, ticker BHP. MP Materials, ticker MP, which also has rare earth exposure. ETFs, iShares, MSCI. Global Metals and Mining, ticker PICK. ProShares S&P Global Core Battery Metals, ticker ION. Cobalt is tricky because of the DRC risk and the LFP substitution risk. But if you believe premium EV demand stays strong, cobalt stays relevant. Rare earths and critical minerals. MP Materials again, ticker MP. Linus, ticker LYSDY over the counter in the US. Energy Fuels, ticker UUUASHA. ETF, VanEck Rare Earth Strategic Metals, ticker REMX. MP Materials is Pentagon backed. 400 million in equity. That's the closest thing to a government guaranteed bet in this space. Re-Element Technologies is private, but has a $1.4 billion Pentagon deal. If they go public, that's one to watch. If you want broad exposure and you don't want to pick individual metals, buy one from each category. LIT for lithium. REMX for rare earths. ION for battery metals. That covers the thesis. You're not betting on one metal or one company, you're betting on the structural shift. The rebuild of a supply chain outside China. 30 billion plus in government money chasing a problem that takes a decade to fix. But let's talk about risks, because this isn't a sure thing. Lithium is still in oversupply in the near term. If EV demand disappoints, if the European car market stays weak, if China's economy slows more than expected, lithium prices could stay flat or even fall. Sodium-ion batteries and solid-state batteries are in development. If either technology scales faster than expected, it could reduce lithium intensity long-term. That's a real risk. Cobalt. The DRC could increase quotas. They've reserved the right to adjust quarterly based on market conditions. If they decide they need revenue more than leverage, they flood the market and cobalt prices crash. LFP adoption is actively reducing cobalt demand. That trend is real. Chemistry substitution is happening. It's just a question of how fast. If LFP takes over faster than expected, cobalt demand peaks sooner and you're left holding a stranded asset. Rare earths. China's export control suspension expires in November 2026. If they renew the suspension, if there's a lasting trade deal, rare earth prices crater. The entire fear premium disappears. If they don't renew it, if controls come back, you get a supply shock and prices spike. But here's the thing. China doesn't want to destroy the market. They want leverage. If they cut off supply completely, the West builds alternatives faster. If they ease up completely, there's no urgency and the West goes back to sleep. China's optimal strategy is controlled tension, just enough pain to remind everyone who's in charge, but not so much pain that it forces a permanent decoupling. That's a tightrope, and it makes rare earth prices incredibly volatile and politically sensitive. The bigger political risk is this. The entire thesis rests on US-China tensions staying elevated, on the West staying committed to building alternatives, on 30 billion in government subsidies actually turning into mines and refineries. But governments change, policies change. Trump leaves office in 4 years, maybe sooner. The next administration might not care about critical minerals. They might cut funding. They might make a trade deal that undercuts domestic producers. You're making a 20-year bet on a 4-year political cycle. That's uncomfortable. And then there's the timeline problem. New mines take 10 to 17 years to develop. Permitting, environmental review, construction, ramp up. It's a decade plus. Some of these companies burning through Pentagon money right now won't be cash flow positive until 2035. What happens if the political winds shift in 2028? What happens if investors lose patience? What happens if China dumps stockpiled materials and crashes prices just long enough to bankrupt competitors? That's not a conspiracy theory, that's the playbook. China has done it before with rare earths in the 2010s. Flood the market, bankrupt Western producers, buy up the assets, consolidate control. They could do it again. But here's the bigger picture. This isn't about lithium versus cobalt versus rare earths. This is about who controls the physical inputs to everything that matters in the 21st century. Electric vehicles, artificial intelligence, defense systems, grid storage, renewable energy, smartphones, all of it runs on batteries. All batteries require these metals, and right now, one country controls the processing. China spent 15 years quietly building this dominance while the West was financializing everything and offshoring production. Nobody was paying attention. Now, everyone's paying attention. And the scramble to fix it is where the opportunity is. 30 billion plus in government commitments, Defense Production Act authorities, the Pentagon taking equity stakes in mining companies, bipartisan political support. This is not normal. This is the US government treating critical minerals the way they treated semiconductors with the CHIPS Act. It's an industrial policy, a recognition that some supply chains are too important to leave to the market. And when governments move this much money this fast, there's a trade to be made. The companies positioned at this intersection, the ones mining outside China, the ones refining outside China, the ones building the alternative supply chain, those are the early movers. Those are the ones getting Pentagon funding, EXIM loans, offtake agreements with automakers. Those are the ones that will either build the next global supply chain or get acquired by majors trying to secure access. Either way, if you're in early, you're positioned for the structural shift. This is the most important supply chain rebuild since semiconductors. And semiconductors taught us something. When national security meets industrial policy meets massive government spending, you get a decade-long bull market in the companies that benefit. Taiwan Semiconductor, ASML, Applied Materials, all of them exploded when chips became a strategic priority. We're at the beginning of that cycle for battery metals. Silver, gold, cobalt, lithium, rare earths, the Fed, China, resource wars. What's the next topic you want me to dig into? Drop it in the comments. That's what this channel is for. I read every single one, and your questions shape what I cover next. The companies moving now are the ones that will define the battery age. The mines being built today will power the grid in 2040. The refineries getting Pentagon funding will process the materials for the next generation of everything. This is not a trade. This is not a momentum play. This is a structural bet on who controls the 21st century. Your future self, the one living in a world where everything runs on batteries, is counting on you to understand what's happening right now. Because the decisions being made today, the investments being deployed today, will determine who wins and who loses for the next 30 years. And you're watching it happen in real time.